Hello, welcome back. Time to talk about a company for which we haven't talked before, and we generally speaking haven't talked about this kind of software before, like ERP software, software that has to do with payroll, talent management, HR, and things of that sort. SAP is the company that we're gonna talk about. It's a huge company, very large company that has massive competitors as well, like Oracle, for instance, Workday. A lot of companies that are actually at the same space. This is a German company, by the way. As you see here is DE. So trading on this New York Stock Exchange, though, so that's important, of course. So let's take a look at what the company is doing financially here and see whether this kind of company is an interesting purchase. Now, I like this kind of software subscription companies because they tend to have like large clients and clients that typically don't switch to other systems because it takes a lot of effort and money. And so they tend to be relatively steady in terms of what kind of revenue they are making, and they generally speaking grow. Now, for this reason, they can be expensive though, so we need to be taking into account what they are doing financially before entering this kind of company. So let's take a look at it. A P ratio of the company is sitting at 21.5 here. It's actually going down from what it was, which is a neat thing to see. And while it has an X here, it could actually be just a green thing here, because it's very close to 20, which is our threshold here, as you can see. But 21.5, yeah, could be definitely acceptable. And price to free cash flow ratio 19.2 as well, so even better. This is good. Let's take a look at the outstanding shares here. They are actually going down slightly, so the company is not at least issuing shares, it's about the same, and buying back a little bit, so that's good. Free cash flow to total liabilities 5.47, about 5.5 years to pay all the total liabilities, if we actually used all the free cash flow that the company generated last year, that is. So that's pretty neat. It's an X, but again, very close to what I like to say, which is less than 5. The company's 5-year revenue growth, though, is not growing that much, 12% in the last 5 years. But the net income growth is actually growing a little bit as well, although, yeah, it had a little bit of a slump. The free cash flow growth also kind of growing, and the total equity growth of the company at 54% here. So company's total equity also growing pretty nicely here. Okay, what about the debt? The debt of the company, yeah, it's a little here, little debt compared to equity. That's good to see, and pretty great current ratio as well. 1.2 is our threshold. Anything above that is good. And this means that our total current assets are more than the current liabilities here, which means that the company has more cash and cash equivalents to serve that they own than the actual current liabilities that they need to serve for the next 12 months. And net income margins are 20% almost. Interesting. A dividend yield, the company is paying a dividend of 2.1% and has a dividend payout ratio of 41.8%, which is definitely sustainable. I'm actually a little bit surprised that this company is paying a dividend yield here. And because this kind of paying dividend yield, actually paying dividends pretty much, kind of holds growth for a bit. It actually releases a lot of actually money back to shareholders, and it can be a good thing for people who are looking for the income. But the thing is, this is inefficient because it's taxed down 2 times. Actually, it's taxed at the company level and the investor level. So it's I guess good for the IRS, but not great for investors. And also, this kind of money is actually not spent for operations of the company. So this is why I'm not a huge fan of dividends, generally speaking. I do have some stocks that have dividends, but typically I prefer companies that are growing their cash flow. So the return on equity here, 15%, not bad at all. But I do want to take a look at the financial statements here, just to quickly see what the company has been doing every year. And you will see here from 28 billion to 31 billion. Yeah, the revenue hasn't grown that much, as you will see here. And so what about the net income? The net income has actually grown more than the revenue, so that's a good thing. 4.8 to 6.1. Not bad at all, but not explosive growth, of course. What about their total assets here? 81 billion. That's a lot of assets, and the total equity is 47.2 billion. Yeah, this is a massive company, of course, as you can understand, and you would expect. Company has a lot of assets. And the net cash provided by operating activities, a little bit down from last year, but still 7 billion here. And investing activities, the company is actually selling some maturities here, but also buying. So they're actually a net buyer for the most part of maturities, of investments. And capital expenditures at about 1 billion pretty much every year for the most part. Normal stuff here. Some acquisitions going on as well. Typical things, nothing concerning. nothing out of the ordinary. 2.4 is the 4 billion is the dividends that are paying, and the free cash flow is 6.1. So we are talking about 35% of their free cash flow is what they're paying out for dividends here. Interesting. And yeah, the free cash flow is also growing here from 4.5 to 6.1. So their numbers are looking pretty neat here, pretty good. The only fact that I'm not a big fan of is the revenue growth, which we examined earlier. And we will see that here it has been 4.8% on average every year, the revenue year-over-year growth. So we have to use something low here. We're going to go 2, 3, and 4 because the company, actually let's go 3, 4, and 5. Give it a little bit of a higher one because it has been close to 5. So the company, yeah, hasn't been growing tremendously, and that's concerning a little bit. It may actually be even less based on what they're doing the last couple of years. Let's see what we're getting out of those first. The net income margins here, 77%. So it makes a lot of sense to use 16, 17, and 18 here for sure. The free cash flow margin, 93% for the most part on average. Makes total sense. Let's go 80, 85, and 95, 90, 93. Let's go here. And annual return of 13% is what I typically want to make, of course. So let's hit calculate and see what we're getting here. Yeah, as I would kind of expect based on the current price and the current projections here, the price of the stock is a little bit higher than what I would like it to be, even for our highest estimates here. So for our low ones, which I typically want to be nearby with my projections, we are a little bit far from what I'd want it to be. So it's a little bit expensive. And I actually used the relatively high revenue growth values. Again, based on what they are doing in the past couple of years, we could even go lower, 1, 2, and 3 here. And this would totally make sense as well for our projections. And in this case, we are sitting at about $50 is where we'd like to get the company at. It's a little bit expensive for what it is, again, right now. And again, based on what they are doing financially, because of their margins, I guess they also skew their stock price down in terms of our projections here. But we have used relatively normal estimates here. I'm fine with this, to tell you the truth. They are not that conservative either, practically speaking. Because remember, also the free cash flow margin was 93%. We used it here. I mean, even if I use it everywhere, let's just say that I use the same free cash flow margin. Let's see what we're getting here. Yeah, this goes a little bit higher here if you are willing to accept the average of the last 5 years, and then we're still going at about maybe $60, $55 to $60. But we are still far from the current price, which is $104 right now. So yeah, interesting company. Looks, you can be a little bit deceived again, and this is why it makes a lot of sense to use the stock evaluation tool. It gives you a much better picture. You can be a little bit deceived by these numbers here because they are looking relatively low. But then if you actually calculate and you take a look at the free cash flow the company is making and the margins that they are having, then you are painting a little bit of a different story, right? So yeah, while the company is definitely not at a horrible spot or anything, I would probably stay away from it. I think it's a little bit expensive for what it is right now, and I would look at better opportunities. Again, this is not a company that's terrible for sure, but I think it's expensive for what it is right now. If it reaches like $50 or so, then I would definitely be interested. So yeah, I'm not sure if that will ever happen really, but yeah, based on what I'm seeing, this is what would make me interested in the company. I hope you enjoyed the video. Please remember to subscribe and leave a like. Very soon I will let you know how to access this awesome tool that we have created here. And thank you for watching this video. I hope you enjoyed, and I'll see you in the next one. In the meantime, take a look at this video that I made earlier, and in this one we are discussing Chipotle, an interesting company that may be worthwhile taking a look at. Thanks for watching this one again, and I'll see you soon. Bye bye.